As of Saturday, April 25, 2026, the market is currently closed. NUBURU Inc., trading under the ticker BURU on the NYSE American, ended its last session on Friday, April 24, at a closing price of 31 cents per share. This represented a sharp intraday decline of 15.17%, a move that wiped out a significant portion of the week's speculative gains. While the official close was 31 cents, after-hours trading saw even further volatility, with the price slipping toward the 28-cent mark as sell-side pressure intensified. For a stock that has seen 52-week highs above $4, this current level reflects a company in the midst of a massive, high-stakes structural shift. You might look at a 15% drop in a single day and assume the floor is falling out, but the reality is far more nuanced. While the surface-level narrative suggests a struggling penny stock, the underlying data reveals a massive surge in trading volume, over 78 million shares in a single session, which is nearly triple its recent daily average. This isn't just retail panic, it's the sound of a cap table being violently rebuilt in real time. The expectation among many casual traders is that NUBURU is a dying laser company, but the reality is that the management has effectively burned the boats. They have pivoted from being a pure-play hardware manufacturer into a sprawling defense and security platform, acquiring software firms and entering joint ventures that target a $20 billion counter-drone market. The recent price action is directly tied to a massive resale registration of 60 million shares. When a company registers that much stock for resale by a selling stockholder, in this case YA I2PN Limited, the market immediately prices in the upcoming dilution. This is the classic tension. The company needs the capital to fund its aggressive defense acquisitions, but the very act of securing that capital creates a temporary ceiling on the stock price. If you're looking for investment help or exploring online investing through platforms like Fidelity or Interactive Brokers, you have to understand that a stock like BURU isn't trading on earnings right now, it's trading on liquidity and survival. Unlike a stable Nvidia stock or a blue-chip Apple stock, NUBURU is a speculative vehicle where the reality is a race between capital exhaustion and revenue generation from new defense contracts. Institutional activity has been a mixed bag of restructuring and exits. We've seen the company work feverishly to clean up its balance sheet, recently eliminating over $8 million in Series A preferred liabilities. This is the kind of boring financial housekeeping that actually matters more than a flashy press release. For users of the Robinhood app or those managing a self-investing strategy through SoFi Invest, it's easy to get distracted by the daily percentage swings. However, the real story is the $25 million debenture and the standby equity purchase agreement. Every dollar the company raises through share sales right now is essentially earmarked to pay down debt before it can even touch the operating budget. This creates a debt overhang that keeps the stock pinned down even when good news hits the wire. Speaking of news, the company has been incredibly active in the first quarter of 2026. They've launched a joint venture with Maddox Defense and are actively building prototypes for the US government. They also recently reactivated a 70% acquisition of Techne, aiming for a defense platform that could eventually see over $100 million in revenue. The market, however, is skeptical. The expectation is that these deals will take years to materialize into cash flow, while the reality is that NUBURU is already launching Phase 1 production for units destined for Ukraine. This creates a disconnect. The business is moving faster than the balance sheet suggests, but the stock price is trapped by the mechanical selling of shares from its financing partners. If you're using investing sites to track your portfolio or perhaps managing your retirement through Fidelity IRAs, you've likely noticed that the broader tech sector has been volatile. But NUBURU doesn't follow the S&P 500, it follows its own internal catalyst calendar. Earlier this year, the company executed a reverse stock split to maintain its NYSE American listing. For many investors, a reverse split is a red flag, a sign of a death spiral. But in this specific reality, it was a tactical necessity to allow the $12 million public offering to close. They are essentially sacrificing short-term share price stability to ensure they have the dry powder needed to integrate acquisitions like Lyocon and Orbit SRL. Comment below how many shares of NUBURU you currently hold, or if you've moved your capital into more stable Fidelity ETFs, or perhaps a Schwab Intelligent portfolio to avoid this kind of microcap volatility. It's a polarized stock, and I want to see which side of the fence you're on. To understand why anyone is still betting on this, you have to look at what NUBURU actually does. At its core, they are the pioneers of high-power blue laser technology. Most industrial lasers use infrared light, which copper and aluminum, the essential metals for electric vehicles and green energy, don't absorb very well. Blue light, however, is absorbed by copper at a rate 10 times higher than infrared. This means you can weld faster, with less heat and with zero defects. This isn't just a marginal improvement, it's a fundamental shift in physics. The business model has shifted from just selling these lasers to integrate them into non-kinetic defense systems, essentially using lasers to knock drones out of the sky without firing a single bullet. In the past, the company's performance was hampered by a lack of commercial scale and high manufacturing costs. They reported a net loss of over $79 million for 2025, with almost zero revenue. That is a staggering number that would scare off most people looking for a safe individual brokerage account. However, the 2026 transformation plan is designed to stop the bleeding by moving toward a licensing and platform-based model. Instead of just building lasers, they are becoming a systems integrator. By acquiring Orbit, they gained a SaaS platform for operational resilience. By partnering with Techne, they gained access to special mission vehicles. They are building an ecosystem where the blue laser is just one component of a much larger defense contract. The institutional smart money often looks at these situations differently than retail traders on the Robinhood trading platform. While a retail investor sees a 31-cent stock and thinks penny stock, an institutional analyst looks at the 120 patents the company holds and the strategic equity position they just took in Heckler & Koch. They are seeing a company that's being priced as if it's going bankrupt, yet it is simultaneously being invited to demonstrate technology for the U.S. Department of Defense. This is the ultimate expectation versus reality play. The market expects bankruptcy. The company is acting like a rising defense prime. Looking ahead, the catalysts are clear but risky. The company has a deadline of July 31, 2026 to get stockholder approval for several key acquisitions. If they fail to get that approval, the entire defense platform strategy could crumble. If they succeed, they could begin consolidating the revenue from Techne and Lyocon, which will finally give them a top-line revenue figure to show investors. For those doing online investing, the risk is that the dilution from the SEPA agreement continues to outpace the positive news. You could see the company sign a $50 million contract, and the stock might still go down if the financing partner is dumping shares to lock in their 3% discount. The future outlook for NUBURU is a binary outcome. Scenario A, the defense contracts ramp up, the revenue from the Gralian units in Ukraine hits the books, and the company finally reaches a break-even point, causing a massive short squeeze and a return to the multi-dollar range. Scenario B, the dilution continues to suppress the price, the company fails to meet its debt obligations to YA2PN, and they are forced into further restructuring or a potential delisting. This is why the stock is a favorite for those using the Fidelity mobile app for high-risk trading, but a nightmare for anyone seeking a set-it-and-forget-it strategy like those found in SoFi Renault Advisor accounts. If you are navigating this market through interactive brokers or using the Robinhood app for its simplicity, you must pay attention to the VWAP or volume-weighted average price. The current financing deals are tied to this metric. As long as the stock remains under high volume and downward pressure, the financing partners have the upper hand. The reality of the situation is that the company is currently a startup that just happens to be publicly traded. They are in a race against time. In summary, the central insight here is that NUBURU is no longer just a laser company, it is a distressed defense tech play. The expectation that the stock is in a terminal decline ignores the aggressive acquisitions and the cleaning of the balance sheet that has occurred over the last 4 months. However, the reality of the 60 million share overhang and the $200 million accumulated deficit cannot be ignored. The contrast between the high-tech potential of blue lasers and the gritty reality of their current financial position creates one of the most volatile opportunities on the NYSE American today. Whether you're looking for investment help with your Fidelity mutual funds or trying to pick the next big winner in the self-investing space, NUBURU serves as a masterclass in market psychology. It reminds us that a company's technology can be world-class, but its stock is ultimately a slave to its capital structure. As we move into the second half of 2026, the success of the Maddox Defense JV and the integration of the Techne revenue will be the only things that matter. The narrative has been set, the piece Pistols. Maintain a disciplined approach, watch the filings more than the price action, and always remember that in the world of microcaps, the loudest reality is often the one hidden in the footnotes of a resale registration. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video. Comment your thoughts. Unshare with your friends. Bell icon, subscribe for more updates.